Today's video, I'll be covering the importance of forming a daily bias. This concept, essentially, I think is the most ignored or misused concept within the beginner trading, where people that stuck in a break-even phase or just being barely profitable. A lot of time is they're failing to correctly identify the daily bias, resulting them identify a plus plus entry, failing a lot of time. If you probably most beginner trader already went through this, is they see all the checkbox or criteria that meet their A++ entry, and where they enter the trade, it goes in their favor for a couple minutes or for a couple candle, and then they reverse on them or stop them out at break even or stop them out at a stop loss for a loss, whatever they have set. And they keep repeating that, and then decrease their confidence and start having doubts within their strategy. Most of the time, it's not a strategy issue. Most of the time, it's because they're not identified the overall higher time frame trend direction of the price. So I'll kind of go over on the importance of trading plans, why trading plan is important. One is giving a clear direction of where the price is going to go, and that filter out a lot of noises. Obviously, that also give you a clear risk and profit targets, which you already know how much you're going to be risking when you put on this trade and how much profit you're going to get. And also, the most important things that I think a lot of trader talks about, but they don't really understand what it means, is disciplines and also being patient, which is your trading emotion. Both disciplines and being patient, these heavily rely on your emotion. Essentially, it's holding back your emotion. Oh, okay, don't put on trade, don't put on trade, don't put on trade. Holding that FOMOing, holding back that fear is very, very dangerous, because a lot of time your emotion will give in. Let's say today you wake up, you're not as sharp, your emotion give in. Let's say you miss a setup this time, and then you saw a trade went your way. The next setup becomes like, okay, I take a trade and then it's a loss. That's based on emotion. A lot of times you want to avoid using disciplines and patience. Yes, they're important, but they're essentially last line of safety, essentially your safety net, before you need to be able to quantify your strategy, right? You want to quantify things to be able to put on a trade without always relying, okay, my patience. No, right? Trading, when you get to a certain point where you become very, very profitable, trading become boring, right? Why is it boring? Because your emotion is not like a roller coaster. You're not relying on discipline. You're not relying on patience. There are only a couple days that those things kick in, because those are your safety net or last resort of your ammunitions. Before, it's just essentially going through your checklist on the day-to-day bias, and you see the same setup, same checklist over and over 100 times, you become very, very, very numb. Numb as in it's become boring. Same thing over and over, right? So a couple things to jump in here as a quick example here on how I identify trade when I mention quantifying things. So first thing is, when I come in, I don't bother even looking at a lower time frame or any trade. I highlight the zone I'm interested in. So in this chart, either you can view it as a support resistance, you can view it as that was supply or demand zone, the same thing. But I mainly use like a fair value gaps or order blocks here. So these are essentially the key zone where I know liquidity or price is going to have some sort of reaction here. Same thing down here. I don't do anything within this, I'll call this gray zone. All these gray zone, I don't take a trade. Most of the time, it's gonna just sit and chop. I only expect some sort of liquidity, high liquidity zone, have some sort of price action to either continue or reverse, right? So this basically get rid of a lot of things, right? You're trading at a premium or a discount, where you either can expect two things: the price come here, slow down, and then reverse, and then target down here to this order block, or prices strongly move up with enough volume. You know that once you break this order blocks, it become breaker, and this supply become demand, or support become resistance become support, that you will have the price continue higher, right? So these are the things that I need to identify. Your trading is like being a sniper, that you don't want to trace your prey, you want the prey come to you. Okay. Most of the time, you don't see sniper constantly moving around, changing their position. They always sit in one position, and let the prey come to them. And once everything fit, they pull the trigger. Same thing with trading. You want to let the trade come to you. You don't want to chase the trade. That's essentially what, having a plan is. If you're constantly chasing a trade, or just to put on a trade, that means you don't even have a trading plan. You're basically just chasing price. You want to only essentially set criteria that I don't do any actions until the price reaches the zone. And once it reaches the zone, I want to do two things. Either it's going to continue or it's going to respect the zone and then reject. And then you take based on whatever, how the price react in the higher time frame, and then you look into the lower time frame for your entry. So let's say this is the zone I mapped out, right? And jumping to the lower time frame, this is the 1 minute. We can see here, once the price pull up to the hourly and also hourly time frame, the water block here, you can see the price start slowing down, start chopping. And then once it took out liquidity, which is this high over here, once it took out liquidity, we want to see the price continue to push above where it doesn't. So you can see the price didn't continue to push above, we respected it, and then it formed some sort of market structure shift or character change. And this is where we start looking for our entry. So we entry at this pull back, bounce back over here, and then we have the risk already set, which is previous high of this liquidity sweep, and then we target all the way down here for sell side liquidity. This essentially give you a clear risk and also clear profit without any fear, right? You already know what the price is gonna do here, either go up or reject. This basically get rid of any emotion relying on discipline, just based on pure price action and based on the quantifiable daily bias and trading plan that you already formed before you even take on the trade. Now let's jump in on how I form my daily bias. And to keep these very, very simple, I only use two things. Higher time frame, order block, and breaker block, and then sometimes fair value gaps. Okay. So first thing, that I do not look anything under them, usually 1 hour. I always, and nothing above 4 hours. For intraday trading, I usually find 4 hours and 1 hour. 1 hour usually is the best time frame to use. And if I don't find anything in the 4 hour or 1 hour time frame, I do look down to 30 minutes, but usually you can find something within 1 hour. So essentially for this 1 hour, I've highlighted the zone of high liquidity that I want to look for, that I see the price expected to have some sort of reaction once it reaches this liquidity zone. And then that's usually where I want to see how the price behave and then pull out a trade. And usually how I identify these zones, I use order block and breaker block. And sometimes I use fair value gap to see if there's any fair value gap overlapping with these breaker block or order blocks. These are essentially high confluence zone that I look for a trade. And by doing this, essentially it show a discount and premium for either potential long entry or potential short entry, give you a better risk and reward. Essentially, if you're taking a long at a discount, essentially your risk is much smaller. Instead of taking all away, once the price already in the gray zone, we're in the middle where the price already start running, your risk is much lower. And same thing, if you're taking a short and the premium, your risk is also defined, closer to lower risk compared to taking a short at a later time. So jumping into here as a quick example of the trade, I have the order block here as what I highlighted here. These are essentially the key zone in the premium level, where I do see the price overlap with the 1 hour and order block. These are essentially what the price I want to see. The price come up here to see if there's some sort of liquidity sweep of this high or this high around here, see if the price continue lower. Same thing at the bottom here. There is a breaker. Once the price went all the way down, form either a support, resistance, supply with demand, however you view this. I just use the breaker block in this case, where this candle up close in the 1 hour. Once it broke up with strong volume the previous day, I always expect the price to pull back here and respect this key liquidity. And also there is another 1 hour that it was respecting 1, 2, 3 candles. There's most likely going to be some sort of reaction here, and obviously we did get here. You can see price pull back here, respected, right? So these are essentially where you'll be looking for a entry if you do want to long, right? For these days, you will be waiting on, you don't pull anything that is short, essentially already in a discount zone, doing any short down here essentially is too risky, right? Even if you put on a short somewhere down here, your risk and reward is not great. Same thing down here, same thing down here, right? Today's open for this day. It will be better for you to enter a long here once you see some sort of price reaction, and then sweep this liquidity. Once it's swept and some sort of entry that you have identified that fit your criteria, then you enter and look for some sort of liquidity up here for your profit targets. This essentially helps you to clear identify on where the price is going, and also how much you're risking for the trade you're going to put on, and also how much profit you can get out of it. Last thing I want to highlight here is a couple key problems that I see when users are identify daily bias, resulting them not correctly identifying or ignoring it. Number one thing is time frame. A lot of new traders or people have been trading stuck at break-even phase is they're zooming into too much. They're looking at 15 minutes, 5 minutes lows are all considered lower time frames. You should be at least minimum looking at 1 hour. I usually only look for 1 hour, and if I don't find anything, I look for 4 hours. If I don't find anything, I zoom down to 30 minutes. Usually between these three, juggling between these time frames, you'll always find some sort of key zone of interest that you can essentially map out. And obviously daily, you don't have to use that, but daily I basically only give you the overall context of macro bias. So essentially, let's say the monthly or the weekly is trending a certain direction, the daily will kind of show you that, and also you can have that use that as an extra confirmation of within your intraday of 1 hour and 4 hour. But I will say usually daily doesn't really impact on how the intraday move as much, since that's either too big of a zone to draw out, or the price typically don't even reach there, since it's much higher. Usually 1 hour is the perfect middle range, a middle ground where the price will see and touch during the intraday. Next thing is essentially you trader are failing to identify a breaker block and order block. Either they not understand the concept or they identify it wrong. So one of the big things on I see why they identify it wrong is essentially being too zoom in. Again, it's time frame issue. For example, let's take a look here. This is essentially a 1 minute up here. You can see there is some sort of order block here. There's, let's say, a 2 upload cancel, and then also there's technically a breaker here. They enter here and then they expect the price to continue moving lower, which is true, right? You are trending down. You have the higher time frame order block that is respecting here, but lower time frame order block, you're expecting to pull here and then go all the way to continue lower. In this case, didn't happen. The price continue moving higher, stop you out, respected its order block, and then later on move lower. Either you can put your entry here and then you stop being at this all the way high, and then your reward is whatever bottom, but that's essentially 1-to-1. The risk and reward is not great. And this is the reason why I say you zoom out. Not every single upclose candle or downclose candle can be used as a order block. The order block has to be obvious, right? So let's say when you zoom in to the higher time frame, this is the 1 hour. When you're looking here, when you highlight it here, what are you highlighting? There's nothing to highlight here. In the 1 minute time frame of this order block, this is essentially, it means nothing with the higher time frame. Obviously, this is gonna break through. When you see this, this is one straight leg down. This is one single leg. Let me draw this out. To me, this is one single leg, and here is showing like maybe 2 legs. But to me, higher time frame is one single leg, right? This is what essentially I'm seeing. Down, up, down, right? My entry, if I want to be here, either I take it up here, which is already here. Once I see this order block, let's say reach here, and it's respecting it, then this will be the change of market structure shift or change of character, where my entry will be around here. Once the rebalance up here, I can enter here, I can enter here, and the price continue lower. And I can put my stop up here, right? Put my stop up here, even when the price came back to my original entry point, that's fine. I will wait it out because price will respect this order block until invalidate this order block. It doesn't really matter. Instead of enter down here and then your risk is all the way up here. That's way too much. So here, even for here, you can also enter, let's say you miss this entry around here, this zone. you can essentially wait until there is some sort of another liquidity sweep up here. Then your entry can be around here, right? Once you have another structure shift, then your entry is here, your risk is here. This is still much better than here than here. Okay, enter here, continue lower for this leg. That's what you want to aim for. A lot of new trader are too zoom in on lower time frame on trying to identify every single order block and wondering why are they failing. It's because they're failing to identify the overall daily bias, which is this order block. Okay, now let's dive into one of our example here. So this is the 1 hour time frame. Before the market open, things I want to do is essentially map out the key zone that I'm interested to put on a trade. Here we can take a look. There is a breaker block. If you don't know how to identify breaker block, you can check out my previous video on that. I go one over a breaker block, and also there's a separate video on order block as well. Essentially, there is a order block before turning the breaker. There's a order block here. The price is respecting it at these 3 zones. Once it break, it becomes a breaker block. Okay. And then there's also a additional confluence here. There is a opening gap between previous day, 1 hour. Okay. Between Tuesday and Wednesday, once open, there's a opening gap created. Usually the price will trend towards it. We see the pre-market, the price already trends join London, Asia going to London hour. It already went all the way up here and then swept that liquidity and downwards. So what we want to see is if we see a continuation lower, and here we want to map out the low part. So I always mark out 2 zones, one the premium, one the discount. So here up here already mark out the premium zone. Now we want to mark the discount. So here this is the 1 hour order block. So I'll highlight here. This is the order block that you can see previously respected. We want to see if the price respect here and then continue going higher, or then respect the zone and then continue lower to grab all these lower resistance here, lower liquidity down here. And same thing above, we want to see if the price continue respect up here before moving back down to the order block. So once we have this map out, essentially we go to lower time frame and just wait. So we can see the price during the market open is ranging between these 2 zones. As I mentioned before, these are the gray zone that I have no interest in. I don't want to participate. These are essentially zones that you will most likely get chopped up. Any quality of trade on here, you won't trend. I'll view them as a scalp. You won't have a smooth trending until there's a clear direction. So here I'll mark out the sell side liquidity that is formed. So this is the buy side, and there's multiple up here. So there's another buy side up here, and there's also another buy side that was formed during higher time frame, and also there's another one here. I mean, there's a lot of low liquidity that can be run through over here, but mainly what I want to look at is I don't really care about anything with the gray. I want to see how the price react up here once the liquidity is swept. Okay, so we will see if the price pull down here to grab these equal low for the sell side liquidity before moving higher. Once it tap into here, or it tap into here, and once it sell these buy side and look for a trade down here. I'll let this play out. So we can price the chop around. Okay, so kind of went too fast, but you can see this Q liquidity already got swept. I'll just draw out this one, and okay, so you can see there are multiple liquidity. This one all got swept. Once it got swept, reached to the zone that we have highlighted. I want to see if there is some sort of market structure shift or change in state of delivery. In this case, we did get a change in state of delivery over here. So I'll highlight that out. Once the change in state of delivery happen, my entry will be at here. Right. So I technically already have this entry missed. I will have enter at this candle over here. Once there's a change in state of delivery of this candle, my entry will be over here. And then my stop already defined here, and then my profit will be at this sell side liquidity for these equal lows. Okay, so this gives you a close to 2.5 RR, which is great for these trade to pull on. Let it play out. So we can see the price is trending lower, and I expect to grab these and go lower. So we can see the price with a lot of momentum always reach to the zone. Why is that? Because this is the sweet spot of liquidity that price want to go. And as I mentioned before, why didn't I look for any trade here? So I want to highlight something very important here. A lot of beginner trader, they will essentially probably enter here. I mean, you could, right? Let's say you enter here, there's a, in the lower time frame, there is a market structure shift or change in state of delivery. And I put my stop at this low, this and candle high, let's say this order block. And then I target for, I don't know, this liquidity, with high liquidity. This is roughly 1 RR, right? It's not great. Versus you can take 2.7 RR. Anything within here is gonna get choppy, right? Let's say if you even enter a short here using this order block, swept these lower liquidity, stopped out up here, and then you try to target down here, but it never reached the liquidity. Never even reached this 2 liquidity up here. And then you move all the way up, get stopped out. This is the reason why I say don't be too rash on put on a trade. You want to identify where you want the trade to happen, which is these 2 zones. You have the premium quadrant and then you have the discount quadrant. Anything in between is noise. You can see once it reaches the premium quadrant, respected some sort of change in delivery, smooth, right? Smooth. This is what you want to look for. Why is it smooth? Because whatever liquidity is up here is done. The liquidity next thing you want to reach for is all the way down here for this liquidity. The one right is sliced right through it like butter. This is the reason why I say it's very important to identify the daily bias. It gives you a higher accuracy on your entry and also higher accuracy for your win rate. And make your A++ setup essentially much more profitable and also much safer with the risk and reward in place. Now let's take a look at an example in gold in a different market over here. So same thing, this applies to any market. We will map out the 1 hour key zone here. So here the key zone I'm looking for is clearly there is a order block before that's respecting here. No candle close above it. I tried pushing above, didn't close, and then get rejected here again. And now we see a foreclosure of candle over here. So I want to mark this out as breaker block. A lot of times that price will come down here, respect the breaker block before moving higher. So this is essentially in the zone I'm looking for my discount today for a long entry. And also I want to look at my order block up here. So here, before we have a impulsive move down, this is essentially consecutive upward candle. This will be my order block that I want to see how the price, let's say, move up here and respect this order block before moving down. These are the 2 key zones I want to look for in this trade. Okay, so now let's jump into lower time frame. So as we highlighted, in between, these are the gray zone that I don't really care about. I want to see some sort of liquidity sweep before in this zone, in this case, where let's say if it's gonna push above and then form some sort of structure where liquidity sweep, that for me to take a short entry. Until then, I don't take anything. So here, right now, there is a sell side liquidity up here, and then obviously the price, there's nothing up here. Right? If I look to the right, there's nothing that I can even mark. So this is way up here for the buy side liquidity. And with this, I can already tell, this should telltale sign that today the market is most likely gonna go up here and create some sort of buy side liquidity, either to move down or continue moving upwards. So what I want to look for is most likely some sort of reaction down the sell side liquidity and form some sort of liquidity sweep before I look for a change in state of delivery or market structure shift. I'll let this play out. So here we can see this liquidity already got swept, equal low. Now we want to see these also have another equal lows that was swept, and we see there's no market structure shift. After this swept, right, there is no market structure shift. Now I want to see if this swept, there's any market structure shift. If not, it's going to go for B's liquidity, but this liquidity already got swept by this candle. I don't foresee being going all the way lower, but we can see. So it doesn't, and you can see they already got a market structure shift. And the entry would have been after changing state of delivery here. Then your entry for a long will be here, and then we can just target it for, let's say, you can target this as well. This will give you a 2.2 R. You can aim for that, but most of the time we'll always go for this order block, this zone, key zone here, since these are majority liquidity that is sitting. And also when we look out, there is really nothing stopping from the price pushing all the way up here. I mean, there is a 1 hour periodic gap, which 1 hour here, so we could aim for that one. So we aim for the bottom of that 1 hour periodic gap, and then we can see how the price play out. Here we go. Took a little bit of while for the price to play out, but you can see once the price reached down here, swept the liquidity, the price essentially is ready to distribute towards this zone. And then even if I play out, I'm pretty sure it's going to come and push way past it. And just to highlight here again, so this is going to next day. But you can see, even when you enter down here and you put your word stop loss down here, it blew right into the 1 hour fair value gap, right? Which could have confluence with this order block. It blew past it, but respected it. This is essentially high liquidity zone. And the reason that, and also we see a sharp reversal on here. Once the liquidity is met without any more momentum to push forward, we'll go way down. And what happened when we move down here? Get close to it, sweep this liquidity, close to this zone, and then push back up. It will always bounce between these two zones. This is the reason why I say avoid taking trade in the middle. If you can take trade here, your risk and reward is very, very skewed. And also your probability of a trade working out is quite low, because most of the time you don't know where the price is going to go. The case price will up and down generate liquidity until it's ready to go in one direction. So that wraps up for today's daily bias video. If you find this video helpful, please share and likes. And also if you have questions regarding how to correctly identify a breaker block or order block, I have a separate video created separately. Please check those out. Breaker block is a little bit more complex, so I will advise to understand what exactly is order block first to correctly identify a breaker block. Happy trading. Stay safe.